Welcome to the Deep Dive. Today, we're looking at a company that, well, by all the usual metrics, probably shouldn't be doing what it's doing. We're talking about a 140-year-old heavy industry manufacturer based in the English Midlands.
Right, Stoke-on-Trent.
And it has just pulled off one of the most successful, most dramatic strategic transformations we've seen in a very long time.
We are talking about Goodwin PLC, that's ticker GDWN on the London Stock Exchange.
Exactly.
And it is a remarkable story. You know, they just recently graduated to the FTSE 250 index.
Which is a huge signal.
It's a huge signal of their scale and, the market finally recognizing what's happening. For decades, they were really just known as a specialized steel casting firm.
Which means they were tied to what? Oil, gas, mining.
Deeply entrenched in that very volatile, very cyclical capital spending of those sectors.
That's the old story. But the new narrative is, it's a fundamental re-engineering of the entire company.
It really is. They have successfully sort of peeled themselves away from that cyclical energy world.
And pivoted everything, the whole organization.
The whole thing. Now they're focused almost exclusively on these high-barrier, specialized manufacturing niches.
Sovereign-backed sectors.
Yeah.
So we're talking defense, nuclear decommissioning, advanced materials.
This isn't just, a minor tweak. It's a wholesale replacement of their business DNA.
And that replacement has not gone unnoticed.
Not at all. The market has re-rated this thing explosively. I think the stock is up something like 190% over the last 12 months.
Wow.
And the whole investment case really hangs on this idea that the transformation has put them right at the intersection of three long-term secular supercycles.
And the financial forecast, it reflects that convergence in a way that is genuinely staggering.
It is. Management put out guidance late in 2025 forecasting a doubling of their pre-tax trading profits.
A doubling. From what to what?
They expect to exceed £71 million for this current fiscal year, FY26, and that's up from $35.5 million just the year before.
And crucially, that's not just a guess. It's backed by real order book.
A massive one. Visible, sticky orders totaling $365 million.
Okay, so that level of growth, that kind of visibility in an industrial company this old, it demands attention.
It absolutely does. So the core mission for this deep dive, and for you listening, is to figure out if this aggressive re-rating, this premium valuation,
Is it justified?
is it really justified by how durable these new high-margin businesses are? We need to really dissect these defense and nuclear contracts.
And we have to scrutinize that blue sky potential, the advanced materials division. Is that real, or is it just a promise on paper?
Exactly. Is this a temporary cyclical peak, or has Goodwin structurally cemented itself as a genuine long-term, high-quality compounder?
I think to figure that out, we have to start at the beginning. You can't understand the pivot without first understanding the foundation, the corporate ethos that made it all possible.
The history is absolutely key here. Goodwin was founded way back in 1883.
So it's seen a thing or two.
Think about it. World wars, depressions, multiple industrial revolutions. To survive for 140 years in heavy industry, you need a unique, enduring philosophy.
And the sources call that the Goodwin ethos.
That's right. And the anchor of that whole ethos is the ownership structure.
The founding Goodwin family.
They still retain about 53% of the voting equity. They are owner-operators in the truest sense of the word. They have complete control over the strategy.
And that control is fundamental to understanding how they operate, right?
It is. It's what allows them to execute this Goodwin ethos, which is all about making big counter-cyclical investments.
So when everyone else is pulling back.
They push forward. Think about most public companies. They're terrified of increasing capex during a downturn because the market will just punish their quarterly earnings. Goodwin is completely insulated from that pressure.
Can you give us a concrete example? Because this sounds like more than just being prudent. It's a high-stakes bet.
Oh, it is. The 2014-2016 oil price collapse is the perfect case study.
Right, when oil and gas spending just evaporated.
It vanished. And that was Goodwin's bread and butter at the time. Most of their competitors were cutting costs, shutting down capacity.
And Goodwin.
They did the exact opposite. They saw the vulnerability and used that downtime to invest, and invest heavily.
And what specifically?
In the foundry, in R&D, all aimed at chasing these highly regulated, sovereign-backed sectors. That choice gave them the years they needed to go through all the audits, all the accreditation processes for defense and nuclear work.
Something you just can't do when your factory is running at full tilt.
Impossible. So instead of maximizing maximizing short-term returns for shareholders. They were maximizing their long-term strategic position.
And that leads right into their operational setup, which is, I mean, it's intensely vertically integrated. It really flies in the face of this whole asset-light trend we've seen for decades.
Absolutely. Unlike competitors who might outsource a specialized casting here, a bit of machining there, Goodwin owns the entire process.
From start to finish.
Literally. From melting the raw metal alloys in their own facility, Goodwin steel castings, all the way through to the precision CNC machining and final assembly at Goodwin International.
So for you listening, what's a tangible benefit of that? Why does that deep integration matter so much in the sectors they're targeting now?
Well, in defense and nuclear, quality control, material pedigree, it's everything.
These are level 1 safety critical components.
Failure is not an option. By owning the entire process, they control everything. The metallurgy, the heat treatment, every single inspection point.
So they give a regulator a complete audit trail.
A complete audit trail and a single point of accountability. Whether it's the U.S. Navy or the U.K.'s Office for Nuclear Regulation, they love that. This control over IP and quality is a massive, massive barrier to entry. Few rivals can offer that complete pedigree from the raw pour to the finished part.
The regulator sees them as a single source of responsibility. It just eliminates all that supply chain risk of using different vendors for different steps.
Precisely. And that accountability is what gets them into the highest margin work. Which brings us back to that structural shift after the oil collapse.
Management realized they had to pivot.
They did. And that pivot, well, it required huge upfront capital.
You mentioned 2 big buckets of investment.
Yes, the source material really highlights the scale of this. Over $50 million was injected just into the foundry.
To do what?
Upgrade capacity by the biggest CNC machines, and crucially, secure those nuclear accreditations. That's a process you measure in years, not months.
Okay, that covers the defense and nuclear side. What about the advanced materials part?
That was another £23 million. A huge outlay invested into their specialized polymer venture, a company called Duvelco. But the key insight here for you is that this heavy investment phase, this decade of strategic spending, is now largely behind them.
So we're at an inflection point.
A major one. The company stops being a heavy capital consumer and starts becoming a heavy cash generator.
They've turned all that fixed capital into sticky, long-term, high-margin revenue. The machine is ready to harvest.
That's the core of the investment thesis right there.
Okay, let's quickly map out the current structure before we dive into the growth drivers.
It's pretty simple. 2 main pillars. First, you have the mechanical engineering division.
That's the gross engine.
That's the one. The foundry, machining, defense, nuclear, and that Duvelco polymer venture. This division is directly responsible for that massive projected profit jump.
And the second pillar.
The refractory engineering division. Think of this as the stable, high-margin, cash-generative bedrock of the company.
Okay.
It includes things like their globally dominant jewelry casting powders, industrial fire protection. It provides the financial floor for the whole operation.
Got it. So let's start with that engine, the part that's driving this extraordinary profit forecast.
Right. So this division is where the market visibility is longest and, frankly, where the competitive moat is deepest.
Why is that?
It's a combination of their specialized capabilities and those specific accreditations we talked about. It means Goodwin is operating in these tiny niche markets where they effectively have, well, a de facto monopoly position, or at least a highly protected duopoly.
Let's start with defense. This seems to be the most exciting and longest-running part of the story, the submarine supercycle.
The current geopolitical environment has kicked off a major recapitalization of Western naval fleets, particularly nuclear submarines.
And Goodwin is right in the middle of it.
Strategically positioned in that whole AUKUS defense sphere. And what really sets them apart for a company their size is this unique transatlantic footprint. They supply critical components to both the UK Royal Navy and the US Navy.
Okay, on the UK side, what programs are we talking about?
They're integrated into the 2 defining programs. So you have components for the active Astute-class attack submarines.
Why?
And then the colossal multi-decade replacement program, the Dreadnought-class ballistic missile submarines.
And the Dreadnought program is the UK's biggest ever defense project.
It is. Its lifespan extends well into the 2030s, maybe even beyond. I mean, you're looking at 20-year revenue lines that cannot be interrupted or easily retendered.
Because the parts they make are integral to the sub's safety case.
Exactly. Often related to propulsion, high-pressure valve systems. Things you can't afford to get wrong.
Now, you said their penetration into the U.S. naval supply chain is maybe even more significant, at least in terms of immediate financial scale.
Absolutely. They're supplying parts for the Virginia-class attack subs and, critically, for the U.S. Navy's #1 top priority program, the Columbia-class.
Which is replacing the old Ohio-class boomers.
That's it. And the total estimated acquisition cost for the Columbia-class is over $126 billion. Goodwin is embedded in the highest priority defense projects on both sides of the Atlantic.
And all this visibility got a huge stamp of approval in September 2025 with that Northrop Grumman deal.
Yes, that agreement was transformative. It wasn't just a simple contract.
What was it then?
It established an exclusivity arrangement for specific mission-critical components for the U.S. submarine build, and it was followed almost immediately by an initial order of $16 million.
Okay, I have to push back a bit here. Management estimates the future potential value of that one partnership could be over $200 million. That sounds like a huge optimistic number. What actually validates that?
That is the crucial question. And it all comes down to the rate of production in the U.S.
How many subs they're building to a year?
Exactly. The U.S. Navy is aggressively trying to ramp up the build rate for both the Virginia and the Columbia classes to maintain strategic deterrence. If that build rate accelerates, and there is immense political will for it to do so, then Goodwin's $200 million estimate becomes highly credible.
Because their component is written into the design specs.
It is. So the key milestone for you to watch is not just the value of the contracts, but the volume of annual components ordered. That will confirm the accelerated production schedule.
Okay, let's establish why this business is so sticky. Why is the competitive moat in defense and nuclear so hard for competitors to cross?
It all starts with accreditation and time. You can't just, decide one day to supply level 1 safety-critical nuclear parts.
It's not an open tender.
Not at all. Qualifying a foundry for this work is a decade-long process. It takes years of audits, sample testing, documentation, personnel qualification, all to get accreditations like ASME.
The American Society of Mechanical Engineers.
Right. Or RCCM, which is the French nuclear standard that's recognized globally. Goodwin holds these crucial stamps of approval.
So even if a competitor built an identical factory tomorrow?
They'd still be 5 to 10 years away from qualifying their first product to be installed in a nuclear submarine.
Time is the ultimate moat.
Exactly. And then there's the physical capacity barrier. Goodwin invested in its ability to cast and machine these enormous components up to 35 tons.
And that's rare.
Casting highly specialized, high-strength alloys in that size, while maintaining nuclear-grade quality and traceability, it's an extremely rare combination anywhere in the world. It restricts almost all their Western competitors.
And once your part is in the design, the cost of switching is?
It's prohibitive. If Goodwin's component is written into the safety case of that vessel or reactor, meaning its material properties have been verified for decades of operation, switching to a new supplier means the customer has to redo years of costly, time-consuming revalidation.
And get regulatory approval all over again.
All over again. That stickiness gives Goodwin immense pricing power and revenue durability. They move from just being a supplier to being a strategic partner.
Let's shift within the mechanical division to another deeply entrenched area, nuclear decommissioning. We're talking about the long-term work at the Sellafield site in Cumbria.
This is a perfect illustration of how they leverage that unique capacity to create a niche monopoly. The Sellafield cleanup is a multi-generational task.
And Goodwin is supplying a key piece of the puzzle.
A very big piece. They're making the 29-ton ductile iron self-shielded box, or SSB.
Okay, explain to us why the material ductile iron is the critical differentiator here. Why is that so important?
This is the nub of the whole advantage. Ductile iron is incredibly dense, and it's the material itself that provides the radiation shielding.
Hence, self-shielded.
Exactly. They are self-shielded boxes. They can be placed directly into storage facilities because the box structure, which is 29 tons of dense metal, contains the intermediate level waste radiation internally.
And how is that different from what competitors like stainless metal craft make?
Well, competitors typically supply stainless steel boxes, and while stainless steel is great for containment, it's a much thinner, less dense material.
So it doesn't provide the shielding on its own.
Not nearly enough.
Yeah.
When you use steel boxes, the customer then has to build this highly complex, expensive, remote handling shielded storage infrastructure around them.
So Goodwin's boxes simplify the whole process.
They simplify the entire storage process by being self-contained. It reduces the need for all that costly external shielding and remote handling.
So their unique ability to cast and machine these massive, dense iron objects to nuclear standards gives them a huge advantage in the UK's biggest cleanup project.
It does. Right now, they are the only UK supplier capable of making these specific boxes for this specific waste stream.
And the numbers.
They have 237 units contracted to date. The total requirement at Sellafield is cited to be up to 747 units.
So at their current production rate, which is about 10 boxes a month,
that contractual need provides a stable, high-margin baseload for the foundry for nearly a decade.
that kind of revenue visibility is exceptionally rare in manufacturing. Now, before we move on, we should just briefly touch on the legacy energy business. It's not the main driver anymore, but it still plays a key role.
Yes, and we're actually seeing an upswing there, driven by the global shift towards energy security and the huge expansion of LNG infrastructure worldwide.
Liquefied natural gas.
Exactly. Noreva GmbH, their German subsidiary, secured its largest ever order $15 million for axial nozzle check valves for an LNG project in 2025.
And that's a great example of the synergy of their vertical integration.
It is. The revenue is important, but what's crucial is that the specialized castings for those massive valves are poured and treated back in the UK foundry.
Which means they keep the margin and use their capacity efficiently.
It ensures optimal capacity utilization of their heavy machinery, absorbs fixed costs, and keeps their skilled workforce busy between the peaks of defense and nuclear production. It's a strategic hedge that maximizes margin.
Okay, that covers the high-growth mechanical engine.
Right.
Now let's look at the other, quieter pillar of the business, the cash compounder.
Right. So if the mechanical division is the high-stakes, sovereign-backed growth driver, the refractory division is what provides the financial stability. It's the high-margin global consumables revenue.
And this part of the business often gets overlooked in the growth story.
It does, but it's the key to the group's consistent, high profitability. We're talking about Goodwin Refractory Services, or GRS.
And their dominance in a very niche market. Investment casting powders for the jewelry industry.
GRS is the global market leader. They command an estimated market share of over 50% for these powders, sold under brands like Gold Star and SRS.
So what are these powders exactly?
They're essentially a specialized high-performance plaster that's used to create the temporary mold for casting precious metals like gold and silver.
Why is this business so profitable and so defensible? I mean, on the surface, it sounds like they're just selling fancy plaster.
The secret is in the chemical complexity and, crucially, risk aversion.
Okay, explain that.
These powders are not simple plaster. The formulation requires extremely precise control over chemical purity, particle size, thermal expansion properties.
All things that matter when you're pouring molten gold.
If the mold expands too quickly or unevenly, or if impurities react with the metal, the finished casting is defective. It's ruined.
And in jewelry manufacturing, a ruined casting is extremely expensive.
That's the key. The cost of the powder is negligible pennies, really, compared to the cost of the gold or silver being cast. We're talking tens of thousands of dollars per batch.
So a manufacturer isn't going to switch to a cheaper, unproven powder.
Never. If they try to save a few dollars on powder and ruin a single batch of gold, they've lost many, many times the cost of the powder they saved. This powerful asymmetry means manufacturers are extremely reluctant to change their trusted brand.
And that risk aversion translates directly into pricing power and customer loyalty for Goodwin.
It creates a beautiful financial profile. High margins, consistent recurring revenue, and very low correlation to the general economy. People buy jewelry whether the stock market is up or down.
And to maintain that global dominance, they've had to be smart about their geographic footprint, especially in Asia.
Right, which is where the bulk of global jewelry manufacturing happens. They mitigate currency and tariff risks by manufacturing locally. They have subsidiaries in China, India, and Thailand.
Which lets them capture market share right where the demand is growing fastest.
Exactly. And India is clearly a massive secular growth story.
Because of the nation's cultural affinity for gold and the rapidly expanding middle class.
It's a huge multi-decade driver. And to capitalize on this, Goodwin just commissioned a brand new 76,000 square foot manufacturing facility in India in 2025.
Which significantly boosts their capacity to serve that market.
And ensures they remain the #1 local supplier.
What about China? We've heard a lot about economic headwinds there. How did this division hold up?
It showed incredible resilience. I mean, despite all the broader economic problems, the refractory division grew its pre-tax profits in China by 33% in FY25.
Wow.
by capturing domestic market share. They focused on that quality-conscious, middle-income jewelry segment. It just proves how sticky their product is, even when buyers are getting more cautious.
We should also quickly mention the diversification inside the refractory division, specifically a company called Hoban International.
Hoban's high-growth niche is a product called Soliform.
Okay.
It's a unique system where you have specialized concrete filled into these permeable bags. They're used for creating underwater barriers, protecting pipelines from scour, and for rapid coastal defense.
And that's growing.
Sales for Soliform were up 80% year-to-date in late 2025. It just shows the division is constantly leveraging its core material science knowledge to find these small, profitable growth avenues outside the main jewelry market.
Okay, so we have this stable, high-margin base providing the cash flow. That's funding the massive growth engine fueled by defense. Now we have to turn to the most speculative part of the story, the potential for exponential growth, the blue sky opportunity that's really propping up that premium valuation.
This is the high-risk, high-reward segment. If the market is willing to pay nearly 30 times forward earnings for Goodwin, it's not just pricing in the defense backlog, it's pricing in the potential success of Duvelco.
Okay, let's define the product they're chasing. Polyamide or PI?
Polyamide is what scientists would call a superpolymer. It has extreme performance characteristics.
Like what?
Incredible thermal stability. It maintains its integrity across a huge temperature range, from cryogenic cold all the way up to over 400 degrees C.
Plus it has superior mechanical strength, low friction, and chemical resistance.
Exactly. These characteristics mean PI is absolutely mandatory in the most demanding applications. Places where failure would result in massive cost or, well, catastrophe.
So we're talking about things like non-lubricated aerospace bushings.
Critical components in downhole oil drilling, plasma torch insulators, and, crucially for the future, wafer carriers in advanced semiconductor manufacturing.
Where outgassing has to be basically zero.
Outgassing, releasing volatile compounds under heat or vacuum has to be minimized. And the global market for these high-performance PI shapes is already valued at somewhere between $1 and $2 billion a year.
But that market is currently dominated by one massive incumbent.
It is entirely dominated by DuPont's Vespel brand. Vespel is the established, qualified industry standard. They've spent decades getting accreditations in aerospace and defense.
But it's also known for being very expensive.
Very expensive, and for having certain performance limitations in the most extreme modern applications. And this is where Goodwin has thrown down the gauntlet.
With their $23 million down investment to develop their competing PI resin, branded Dukoya.
Their entire strategy here hinges on a technological innovation that's protected by their own IP.
Tell us about the patent they secured in May 2025. This seems to be the core of their moat in this advanced material space.
That patent covers a novel manufacturing process. It uses supercritical carbon dioxide, SCO2, to purify the polymer resin.
Okay, break that down for us. What is supercritical CO2?
To simplify, it's a state where CO2 is held above its critical temperature and pressure. It lets it act like both a gas, so it can diffuse easily into materials, and a liquid, so it can dissolve substances.
And why is that better for purifying a polymer than the traditional methods?
Well, traditional methods often leave tiny amounts of solvents or impurities trapped inside the polymer structure.
Which can later outgas in a sensitive environment like a vacuum chamber.
Exactly. They release these volatile compounds and contaminate sensitive equipment. Management's claim is that using this SCO2 process to purify the polymer results in a significantly cleaner material.
And a cleaner material means better performance in those critical applications.
Precisely. They claim the resulting Dukoya polymer has superior wear resistance and substantially lower outgassing compared to Vespel. This lets them position Dukoya not as a cheap copycat, but as a premium performance alternative.
Aimed at the most demanding new applications.
Like advanced lithography and semiconductors or 400 degrees C jet engine bearings.
And their commercial strategy is vertically integrated, just like the rest of the business. They aren't just selling the raw resin.
Correct. They're attacking the market from two sides. They'll sell the raw resin, but they've also built a highly specialized CNC pressing and machining facility at their Noreva site in Germany.
So they can sell finished, high-precision machined parts made of Dukoya.
And retain the entire value chain margin, ensuring total quality control for the end user.
Okay, let's talk about the potential here. Management suggests that if Duvelco captures just 10% to 20% of the existing Vespel market, it could double the group's profitability again, from the already high FY26 forecast.
It's an enormous claim.
An enormous claim.
Yeah.
So what's the risk? What derails this whole thing?
The risk is huge. And it is all about qualification and execution.
The industries they're targeting, aerospace, semiconductors, are incredibly conservative.
Perhaps the most conservative supply chains in the world, they will not switch a critical material just because it's theoretically better or a little cheaper.
So the qualification process takes years, even if the material is perfect.
It takes years of flight hours, rigorous material testing, auditing by the major OEMs like Boeing, Airbus, or the big semiconductor equipment makers. Displacing a qualified incumbent like Vespel, which has decades of a proven track record, is exceptionally difficult.
And that execution risk.
That execution risk, the time and cost it takes to get product acceptance, is the critical factor influencing Goodwin's premium valuation. If Duvelco fails to gain traction in major applications, the market will rapidly derate that blue sky premium.
It's the ultimate swing factor.
Okay.
We've laid out the structural growth and the optionality. Let's ground this story in the financial reality and talk about that valuation premium.
So that strategic pivot to defense, nuclear, and polymers is just generating massive operational leverage.
Oh.
As the foundry moves from low-margin, volatile energy work to high-margin, sticky sovereign contracts, the fixed costs of all that multi-million-pound machinery are absorbed much more efficiently.
Which leads directly to the earnings explosion.
Exactly. Let's just review that trajectory again. We're going from $35.5 million in pre-tax profits in FY25
to a forecast of over £71 million in FY26.
And that doubling is driven by a material shift in the margin profile. The gross margin expanded to 42% in FY25, and the forward guidance implies a group pre-tax profit margin of over 25%.
That's not the margin of a general industrial firm.
Not at all. That's the margin of a highly specialized niche monopolist. It reflects the pricing power they get from their unique accreditations and their IP control.
Now let's talk about a powerful structural advantage that really boosts their net income: the UK patent box tax regime. This is something that's often missed by international investors.
It's a key reason why their net income growth can actually outpace their pre-tax profit growth. The UK patent box is a unique government incentive.
What does it do?
It allows companies to tax profits that are derived from patented inventions at a much lower rate of just 10%.
And that's way below the UK standard 25% corporate tax rate.
Substantially lower. And Goodwin is leveraging this across multiple areas. Radar systems that Duvelco CO2 process specialized casting methods.
So as their revenue from these patented products grows,
Especially Duvelco and the defense components, their overall effective tax rate will continue to trend lower than that 25% statutory rate. It's a structural tax advantage that provides a direct, significant boost to their earnings per share.
and it makes them fundamentally more profitable than a similar company based elsewhere.
It does.
We mentioned that the heavy investment phase is over. What does that transition look like on the balance sheet?
It signals the transition from being a capital consumer to a capital harvester. Cash generated from operations literally doubled to £67 million in FY25.
Which has allowed them to do what?
Aggressively pay down debt. Net debt is approaching zero, giving them what the sources rightfully call a fortress balance sheet.
And that financial strength allows for a clear return of capital to shareholders. It signals that management believes this new earnings base is durable.
Precisely. They showed that confidence by increasing the FY25 dividend by a massive 111%.
Wow.
And even more tellingly, they declared a special dividend of 532p for FY26 and structurally shifted their dividend policy to a higher payout ratio, aiming for around 58% of profits.
That confirms that management sees the £71 million profit base as the new normal, not just a temporary spike.
That's the signal they're sending.
Okay, let's tackle the elephant in the room, valuation. The stock is up 190%. If you look backwards, a trailing PE of 62 times FY25 earnings just seems astronomical.
It does, but that optically high number is a function of the fact that the market has already priced in the profit doubling.
It's looking forward, not back.
Exactly. If we use that projected 71 million pre-tax profit for FY26 and apply a conservative 25% tax rate, the forward PE ratio drops significantly. It comes down to around 28.6x.
So how does that multiple, let's say 25x to 30x position Goodwin within the broader UK industrial sector?
Right.
Is that cheap, expensive, or about right?
Well, it's clearly trading at a justifiable premium to general diversified industrials.
Cool.
Firms like Weir Group or Rotork, they have lower growth, more cyclical exposure, and they typically trade between 17 and 22 times earnings. Goodwin's higher multiple is earned through its 100% growth and the incredible quality of its long-term defense-backed backlog.
But they still trade at a discount to the true blue-chip quality compounders in the UK.
They do. They are slightly cheaper than established quality compounders like Sperax Group, which often trades around 30 times or higher, or Judges Scientific, which is closer to 33x.
And why is there that discount?
It probably reflects two things: the execution risk in Duvelco, which we talked about, and the corporate governance structure linked to that family control.
Let's touch on that governance structure again. The 53% family stake is the reason they could make these long-term bets.
It is.
But it also creates friction with minority shareholders.
It's a classic paradox. The long-term alignment is a massive pro. It ensures management isn't distracted by short-term demands. The con, however, is limited minority shareholder influence.
And historically, there were concerns about board independence.
There were. The board lacked independent non-executive directors, which drew criticism from institutions.
But are they taking steps to fix that?
Yes. The sources confirm they've made recent moves to modernize governance, including external appointments. And to address the low liquidity from the high family ownership, they recently conducted a small sale of 1.6% of their holdings to institutional investors to increase the free float a little.
Okay, finally, what are the most critical risks that could interrupt this perfect growth story?
The primary risk is concentration. While that 365 million order book is massive, it is heavily dependent on just a few decades-long programs.
The Sellafield boxes, the UK Dreadnought program, and the U.S. Columbia class.
Right. And while cancellation is highly unlikely given the strategic necessity of these programs, significant political delays or budget cuts could impact the expected ramp-up rate. It could push revenue out.
And then there's the high-risk, high-reward Duvelco venture.
That is the second major internal risk. If Duvelco fails to achieve commercial qualification with a major aerospace or semiconductor OEM, or if DuPont uses its market power to crush the competition,
The market would quickly remove that growth premium from the valuation.
instantly. That remains the key internal technical risk to monitor.
And operationally, they have to deal with the scarcity of highly specialized talent.
It's a critical constraint. Manufacturing level 1 nuclear components requires highly skilled labor in metallurgy, non-destructive testing, advanced CNC programming.
And there's a shortage of those skills.
A structural shortage in the UK manufacturing sector. And while Goodwin runs its own excellent training center, it still places a constraint on their ability to rapidly expand capacity to meet that accelerating order book.
This has been an incredibly detailed breakdown of a truly unique industrial transformation story. #outro.
To synthesize the entire picture, Goodwin PLC has successfully transformed itself. It's gone from being a cyclical supplier, reliant on energy capex, into a strategic, entrenched prime contractor for critical Western defense and infrastructure.
They've engineered these de facto monopolies in key niches, like the Sellafield boxes and the jewelry casting powders.
And they now possess a 20-plus year pipeline of long-term defense work across the AU-US nations.
And crucially, that forecast doubling of profits in FY26 isn't seen as some accidental peak. It's the structural harvesting of a decade of relentless, focused, counter-cyclical investment in these high-barrier assets.
And the valuation at around 28.6 times forward PE reflects the market's acceptance of this new quality, this new resilience, and this new growth trajectory.
So for you, the listener, who is tracking the longevity of this investment case, here are the 3 definitive catalysts that you absolutely must monitor over the next 18 months.
Number 1. Watch for the first major contract announcements that validate the Dukoya polyimide resin, specifically qualification in those conservative sectors like aerospace or semiconductor OEMs. That's the signal that the execution risk is receding.
Number 2, look for the official confirmation of the full 747 unit tender for the self-shielded boxes at Sellafield. Securing that full order book converts a decade-long baseload into a secured, bankable contract.
And number 3. Monitor the conversion of that strategic collaboration with Northrop Grumman into a visible, substantial serial production schedule. That's what will move the order trajectory towards that massive potential of over $200 million.
Goodwin's long and successful transformation is a fascinating case study in the power of ownership structure. The family's controlling stake allowed them to completely resist the market's short-term pressures.
Which enabled them to invest tens of millions over a decade into developing the necessary accreditations and assets that are required for national security work.
So this raises an important question for you to consider as you digest this deep dive. In an investment world that's dominated by high-frequency trading and the relentless tyranny of the quarterly earnings report, is this long-term owner-operator model, this fundamental Goodwin ethos, the necessary price of admission for building and sustaining critical, high-barrier national capabilities?
Is short-term market efficiency, in other words, incompatible with long-term strategic necessity? Something to mull over as you watch this story unfold.
Indeed. We'll catch you next time on The Deep Dive.